Thanks, everyone. Fiore Gold is a new, relatively new Nevada gold producer. We bought the former Midway Gold assets out of bankruptcy back in 2016 and immediately set about turning them around and turning what had been a bankrupt and much unloved asset into a cash flowing operation that's continuing to operate strongly today. We bought the property, as I said, in 2016, went into full production in 2017, September of 2017, in our first fiscal year. We produced 34,000 ounces. This current fiscal year, which ends in a couple of days, will produce somewhere between 40 to 43,000 ounces. And that was all as a run-of-mine operation in Nevada. We've now put in a crusher. We're currently ramping that crusher up. And as we go into the next fiscal year, we'll go almost exclusively to crushed ore, and that should take our production up at the same mining rate to something in the neighborhood of 45 to 50,000 ounces a year. Pan, as a mine, is operating very nicely now. There isn't a lot more to do there other than keep drilling and keep extending the mine life. So we've now turned our sights to our growth project, which is right next door on the same concession package, called Gold Rock. Gold Rock is fully federally permitted for mining, which makes it rather rare in anywhere in the US right now. And that permitting process had been started many years ago by Midway Gold, the previous owner. They had done this all on an internal technical study, so there's never been a 43101 technical study other than resource updates published on Gold Rock. So we are updating that now. We'll have a PEA out in that project, which will give you the first kind of economic look at the deposit by year end, and then we're going straight into a feasibility study with the goal of getting that into production as soon as possible. Notionally, Gold Rock could produce somewhere in that 50 to 75,000 ounce a year range, combined with Pan, really as a kind of single unified operation. We'd be looking at a new Nevada 100,000 ounce plus producer. And then of course, we're looking at M&A in terms of complementary single asset type producers that could benefit from being part of a larger group. So there's our Pan mine. Pan is a pretty basic open pit Nevada Carlin heap leach style deposit. Let's see if the laser pointer works. Two pits, the south pit here, the north pit here, central leach pad area, ADR plant where we extract the gold and pour doré. We combine ore from the two pits onto the leach pad, and it's really that combination of taking rocky ore from the north pit with much more clay-rich ore from the south pit and blending those on the leach pad that allows us to maintain permeability on the leach pad, get flow through the leach pad, and extract gold. The previous operator, the bankruptcy, was largely as a result of only mining from that south pit, and as a result they ended up with a lot of clay on the leach pad and blinded it off, and we've since completely solved that problem. We can talk a lot about the things we did there, but I think the proof is in the pudding. You can see the last several quarters we've had increasing gold production. This is under a run-of-mine scenario where we simply mine the ore and dump it on the leach pad with trucks. We're stabilizing now, probably hitting steady state at somewhere between 10 and 11,000 ounces a year as run-of-mine. As I said, we've switched over, or in the process of switching over, to exclusively crushed ore, and that'll add 6,000 or 7,000 ounces a year to that production profile. Costs have generally been cash costs between 900 and 1,000, all-in sustaining costs on a corporate level between sort of 900 or 1,000 and 1,100. We've seen a little bit of cost pressure in the last quarter, and we'll see that again carrying on for the next couple of quarters as we go into a higher strip phase at Pan. Pan has a life of mine strip of about 1.6 to 1. We're currently stripping at about 2 to 1, and we'll see that higher strip for a couple of quarters, and then that'll fall off again towards the middle of next year, which impacts our costs and obviously impacts the profitability. But even at these current strips, we're generating some pretty decent cash flow out of the mine, both on an operating cash flow out of the mine level and operating cash flow at a corporate level. And you can see that, Fiore Gold as a company generated 2.4 million in operating cash flow in the last quarter, and that was at a 13.18 realized gold price. So obviously looks better at higher gold prices that we're seeing now. As I said, Pan is running smoothly. The key focus there now is extending the mine life. This is an aerial view of the mine, the north pit, the south pit, the leach pads. There's a major structural trend called the Branham Fault that runs north-south through here. That controls the mineralization. We'll be drilling there. Actually, we're drilling there now to add resources, to add reserves. We've already had one successful drill program to extend the mine life in 2018. And we're pretty confident that we can both add ounces in and around the mine that will go into the mine plan. And also this year we'll be testing some of these more distal targets that were identified by Midway Gold, but never drilled. So again, Pan's never going to have a 10-year mine life, but I'm hoping that 10 years from now it'll still have a 5-year mine life. The overall land package that you saw there is actually just one part of our much larger land package. We have about 200 square kilometers of contiguous ground in Nevada. But we're now turning our attention to our growth project, which is called Gold Rock. And Gold Rock, as I said, is about 8 miles away. There's a former open pit there that was mined in the 1990s. It's a relatively small open pit. What that does is really gives us a nice 3D view of the ore body, but not much else. You can see here, Pan is up here. This is Highway 50 that runs through Nevada. And for those of you who are familiar with Nevada, the south end of the Battle Mountain Eureka Trend, the town of Eureka, sits right about there just off the screen. Gold Rock is down here, about 8 miles away as the crow flies. And Gold Rock is situated on this structural trend that runs up for about 16 kilometers through the property. The current resource of about 400,000 ounces all in sits in just 2 or 3 kilometers of that particular trend. The prospectivity of this trend is one of the reasons that Kinross came in as a strategic investor. Kinross owns about 6% of the company. Their Bald Mountain mine, very similar geology, is just to the north of us here on the other side of the highway. One thing to note, Gold Rock has about 60% higher grades than Pan. And it also seems to have better metallurgical recoveries based on the testing we've done to date. So, as I said, we're wrapping up a PEA, which should be out by year end on this. We've been drilling there all summer, so we're hoping to grow the resource base as well. And then we'll go straight into a feasibility study on Pan. We believe that even the numbers in the PEA, in terms of CapEx and OpEx, will be very, very accurate because we're operating a mine right next door that's very, very similar, another open pit heap leach operation. So we know what it costs to mine a ton of rock. We know what cyanide costs. We know what labor rates are. And really the goal is, as we bring this into production, to operate them as part of a complex. So here's Pan. This is the road that will connect the two mines. This is the power line that already exists that goes up to Pan, so power is basically on the doorstep. We envisage having an open pit mine, heap leach operation, leach pads and ponds, and then just have carbon columns down here. And then we won't build an ADR plant down here. We'll simply truck the loaded carbon this sort of 10 or 11 miles up the road to Pan, use the existing facilities, strip the carbon, regenerate it, use the refinery at Pan. We'll use the assay lab up here. We'll use a lot of the same management team, a lot of the admin team, really bringing the costs down both on CapEx and OpEx for both operations. As I said, we've been drilling as part of the feasibility study, or the PEA rather, and you can see some of the drill results here. We're getting nothing particularly surprising, exactly what we expected to find, expanding the inferred resource envelope, extending the mineralization along strike, and I have to say we've been pretty happy with the drill results to date. We'll have more drill results coming out up to year end. And then finally, we have one other kind of interesting project up in Washington State that we got as part of the bankruptcy process. It's called Golden Eagle. It's near the town of Republic, Washington, an old historic mining district. In fact, the last two active mines in the area are just in the process of shutting down. They're Kinross's Buckhorn and Kettle River mine. There's the Canadian border for reference. This has a historical non-43-101 resource of 1.74 million ounces at 1.89 grams per ton. It's a refractory sulfide ore body. But keep in mind that was done at 750 gold. If you redo that as we've done at 1250 gold, which actually looks a bit conservative today, you're up somewhere in the vicinity of 2.2 million ounces. That's a pit-constrained resource. This kind of greeny yellow shell here is the pit, the conceptual pit. The problem is that Hecla's ground clips into the edge of that pit on both sides. Hecla controls a lot of the ground around us. We've been in discussions with Hecla for about the last year. They've told us that they have about 1.5 million ounce in-house resource next door. And so we've been talking with them about unifying this. Originally, we had hoped that Hecla would just pick this project up and run with it. But Hecla's had some challenges lately with some of the acquisitions they've made in Nevada. So I think our focus is more turning towards, well, why don't we unify the area? And, because we like this. I mean, conceptually, if you put this together with what Hecla has, redo the resources at more like $1,300, you're looking at a 4 million ounce potential resource here in the US, and there are very few of those on the market right now. In fact, there are very few of those outside the hands of the majors. So again, it's an interesting project. Costs us 10 grand a year to hold, so it's not a particularly expensive project, but we think we can advance it this year as we unify that with Hecla's ground. And again, stay tuned for hopefully some updates on that. Pretty simple share structure, 97 million shares outstanding. We have not issued equity since we picked up the properties, the Midway assets, and changed the company 2 years ago. We funded everything out of cash flow. and we continue to fund everything out of cash flow. We've got a strong balance sheet, US $9.7 million in the bank as of our last quarter, 22 million in net working capital, and compare that to a US market cap of about $34 million. All of our market cap virtually is underpinned by our cash and our working capital. The warrants and options are well out of the money, so really that share count is going to stay pretty constant. In terms of rating, look at some of the sort of typical metrics, EV per gold resource ounce or EV per gold production ounce, and you can see we are well at the bottom end of our comparable peers. There's some similar sized producers, slightly larger producers that are trading at much higher valuations. And again, we think as people start to get an idea of what the net asset value type look of Gold Rock is as this PEA comes out, there's potential there for a significant re-rate. So just to wrap up, key catalysts, we've generally tried to operate under the under-promise and over-deliver philosophy. We've successfully ramped up the Pan mine. It's generating cash flow, it's generating free cash flow as a company. We've extended the mine life. We'll be drilling again now to extend the mine life even further. We've permitted Gold Rock, and we've got the crusher installed and operating at Pan. Over the next few months, you'll see Gold Rock resource expansion, drilling, met results, culminating in a PEA by the end of the year, and then straight into a feasibility. You'll see Pan resource expansion drilling that began earlier this week. And then hopefully we'd like to see some consolidation. There are a number of single asset small producers in the US and adjacent countries that really don't make sense as single asset standalone producers. We think they make a lot more sense as part of a larger multi-ounce producing company. And we'll keep you up to date on that. And then finally, we want to unlock value in our Golden Eagle property in Washington State, and also some exploration assets that we have in Chile from previous incarnation. And my time is up. Thank you very much.
And we have time for a couple of questions. Anyone like to ask a question? I love a simple story. There you go.
Can you quickly describe the metrics you bought it out of bankruptcy for?
Yeah, so the mine, Midway had probably spent somewhere between 90 and $100 million US building that mine about 2 years before. We picked it up out of bankruptcy for $5.5 million cash. And the only liability that we inherited from that was the reclamation liability, which is always going with the property, which is about a $15 million reclamation liability. It's funded by a bond and supported by about 6.5 million of restricted cash. So, yeah, no, they were. It was definitely the bargain of the century.
Actually, it's from my own point, it's a great example of a company that Midway Gold got themselves into trouble and couldn't get themselves out of it, and that kind of stigma normally carries on for some time, but Tim and his team have solved that problem and turned the whole thing around, and I'm glad we were involved to help kind of get over that initial whole project catalyst. So there you go. We've been delighted.
One of the things that's obviously helped us a lot is that Midway was fairly burdened by debt. We have no debt on a corporate level at all, so it gives us a lot more flexibility. Anyway.
Okay.